Microsoft just announced a $5.5 billion investment in Singapore. That's billion with a B. But here's what Wall Street really heard. Big tech is fundamentally restructuring how it deploys capital in the AI era. Today, I'm breaking down why this matters far beyond Microsoft and what it teaches us about the next decade of tech investing. Let's start with the headline. Microsoft is building massive AI data centers in Singapore. Think of data centers as the physical factories where AI actually happens. When you use ChatGPT or any AI tool, you're not accessing some magical cloud. You're sending a request to a physical building filled with thousands of specialized computer chips. These chips, primarily NVIDIA GPUs, perform trillions of calculations per second. They require enormous amounts of electricity and sophisticated cooling systems. A single large AI data center can consume as much power as a small city. Now, why Singapore specifically? This is where it gets strategically interesting. Singapore sits at the crossroads of Southeast Asia. It has world-class infrastructure, stable governance, and strong intellectual property protections. But the deeper reason is geopolitical diversification. Let me explain this concept simply. For decades, big tech concentrated data centers in the United States and a few Western allies. This made sense when data sovereignty and geopolitical tensions were lower. But we now live in a multipolar world. China is building its own AI ecosystem behind regulatory walls. Europe has strict data localization requirements under GDPR. The Middle East, as recent news shows, faces infrastructure vulnerability from regional conflicts. So Microsoft is essentially building a distributed global network. Think of it like not putting all your eggs in one basket, but at a $50 billion scale. This strategy is called geographic risk mitigation. Now let's talk about the energy crisis nobody's discussing enough. AI is incredibly power hungry. According to industry estimates, big tech will spend over $635 billion on AI infrastructure by 2026. But here's the bottleneck: energy availability. You can't just build a data center anywhere. You need access to reliable, massive-scale electricity. This is why Microsoft, Google, and Amazon are all investing in nuclear power and renewable energy projects. Microsoft recently signed a deal to restart the 3 Mile Island nuclear plant. Google is funding small modular reactor development. These aren't just environmental PR moves, they're strategic necessities. Without solving the energy equation, the AI boom hits a physical wall. This creates a fascinating investment thesis. Let's talk about how a beginner should think about this. First, understand the AI value chain. At the top, you have application companies like OpenAI and Anthropic. These are mostly private and inaccessible to retail investors. Below that, you have cloud infrastructure providers, Microsoft Azure, Amazon Web Services, Google Cloud. These are the picks and shovels of the AI gold rush. Then you have the semiconductor manufacturers, NVIDIA, AMD, and increasingly, companies like Marvel. Finally, you have the energy and utilities layer that powers everything. For a beginner, the safest approach is broad diversification. Consider researching, and I emphasize researching, not blindly buying, broad technology ETFs. Examples include the Invesco QQQ Trust, which tracks the NASDAQ 100, or the Technology Select Sector SPDR Fund, ticker symbol XLK. These give you exposure to Microsoft, Apple, NVIDIA, and other mega-cap tech companies. You're not betting on one company's execution, you're betting on the broader trend. Now, if you want more targeted AI exposure, there are AI-specific ETFs. The Global X Artificial Intelligence and Technology ETF, ticker AIQ, is one example. The Roundhill Generative AI and Technology ETF, ticker CHAT, is another. But here's the critical warning. These thematic ETFs can be volatile. They often have higher expense ratios, and they may hold smaller, less established companies. So position sizing is crucial. A common beginner mistake is going all in on a hot theme. A more prudent approach: limit thematic bets to 5 to 10% of your portfolio. Keep the core in diversified index funds. Now let's discuss risk management, which is non-negotiable. The AI boom is real, but it's not guaranteed to be linear. We've seen hype cycles before: the dot-com bubble, the blockchain craze. Many companies will fail. Even winners can experience severe drawdowns. NVIDIA, for example, fell 70% from peak to trough in 2022. If you had panic sold, you'd have missed the subsequent 500% rally. This is why you need a time horizon of at least 5 to 7 years. AI infrastructure is a long-term build-out. It won't pay off in 6 months. You also need to understand valuation risk. Microsoft currently trades at around 30 times forward earnings. That's expensive by historical standards. It implies the market expects significant growth. If AI monetization disappoints, these stocks can correct sharply. So dollar cost averaging is your friend. Instead of investing $10,000 today, invest $2,000 per quarter over 5 quarters. This smooths out volatility and removes emotion from the equation. Let's also talk about the Oracle situation briefly. Oracle just laid off 30,000 employees while posting $6 billion in quarterly profit. This seems contradictory, but it's actually a textbook corporate restructuring. Oracle is shifting from legacy software maintenance to AI cloud services. Layoffs are concentrated in older business units. New hiring is focused on AI engineers and cloud specialists. This is what economist Joseph Schumpeter called creative destruction. Old business models die. New ones are born. For investors, this means even established tech giants carry execution risk. Not every company will successfully navigate the AI transition. IBM, for example, missed the cloud revolution and paid the price for a decade. So diversification isn't just about spreading risk across sectors, it's about spreading risk across different companies' execution capabilities. Now before we wrap, let me give you a 3-step action plan. Step 1, educate yourself on the AI value chain. Read quarterly earnings calls from Microsoft, Amazon, and Google. These are free and publicly available. Listen for mentions of capital expenditure, data center builds, and energy costs. Step 2, build a diversified core portfolio first. At least 70% should be in broad market index funds. This is your financial foundation. Step 3, allocate a small percentage to thematic AI exposure. Use ETFs, not individual stocks, unless you have deep sector expertise. Rebalance annually to maintain your target allocation. And critically, do not invest money you'll need within 5 years. AI is a long-term secular trend, not a get-rich-quick scheme. Now, my mandatory disclaimer. I am not a licensed financial advisor. This video is for educational purposes only. All investments carry risk, including potential loss of principal. Past performance does not guarantee future results. You must do your own due diligence and consult a licensed professional before making investment decisions. The ETFs and companies I mentioned are examples for research, not buy recommendations. Your financial situation is unique. What works for one investor may be completely inappropriate for another. Always consider your risk tolerance, time horizon, and financial goals. Okay, let's recap. Microsoft's Singapore investment is a signal, not just a headline. It tells us big tech is diversifying geographically due to energy constraints and geopolitical risk. The AI infrastructure boom is real, but it requires patient, diversified capital. For beginners, broad ETFs are safer than individual stock bets. Position sizing and time horizon are your 2 most important risk controls. And remember, investing is a marathon, not a sprint. If you found this valuable, subscribe for weekly macro investing education. Drop a comment with your biggest takeaway, and I'll see you in the next one.